Good afternoon, everyone. I am Wang Jianfeng and my matrix number is 2320-3120. Today I will present how we built an adaptive early warning system for Brazilian listed firms and why a lightweight Gaussian naive Bayes classifier ultimately outperformed deeper and more complex models. Here is what I will cover. I will begin with background and motivation, followed by a walkthrough of our methodology, the model comparison we call the championship exam, our results, and the real-world implications. That's the outline. Now let's get into the details. Financial distress can erase firm value in a matter of hours, just think of audit failures that cause stock price to crash by 30%. Traditional ratio-based models such as those by Fitzpatrick and Altman assume data stationarity. However, modern financial data, particularly quarter fillings, frequently exhibit shifts in distribution. Our objective is to develop an early warning model capable of adapting to these changes in real time. So what does the data environment actually look like? In our Brazilian datasets, only 2.7% of firm quarters are labeled distress, highlighting an extreme class imbalance. Moreover, financial ratios shift in response to regulation and commodity price shocks, introducing concept drifts, static models that trained ones cannot accommodate such changes. The current challenge is this: how can we reliably predict financial distress in a continuously evolving data stream? They offer an ideal setting. It is a commodity-dependent, heavily regulated, and volatile market. Previous research, such as Chavez et al. 2023, achieved an AUC of approximately 0.95 using a drift-aware algorithm, but only for a single model. Meanwhile, regulatory authorities increasingly demand explainable AI. Our study integrates drift adaptation, imbalance mitigation, and interpretability into an unified machine learning pipeline. This study has three primary objectives. One, to develop a drift-aware processing pipeline to benchmark multiple machine learning models under the conditions of drift and class imbalance. And three, to evaluate the effectiveness of stream learning strategies such as sliding window and incremental updates. This leads to three research questions. How can we effectively detect drift? Which models exhibit the highest adaptability, and to what extent do stream learning techniques help maintain predictive performance? Our dataset includes 905 Brazilian firms over the period 2011 to 2020, totaling 23,834 firms quarters and 84 financial ratios. The analysis focus on solely firm-level financial data. Microeconomic and sentiment factors are not included. Distress is defined as binary outcomes based on regulatory criteria such as negative equity, where traditional machine learning has improved accuracy in static datasets. Few studies address the intersection of four key challenges: non-stationarity, severe class imbalance, and multimodal benchmarking and interpretability. This is precisely the gap that our research searches to fill. Our pipeline begins with data cleaning and the construction of four-quarter lag window. We compare four models families: one, adaptive batch learner, naive Bayes logistic regression, and XGBoost trained on each window; two, static deep network such as ANNLSTM and BIGRU trained ones and held fixed; three, a true online ensemble adaptive random forest with headwind drift detection; and four, anomaly detection via autoencoders. To address imbalance, we apply class weighting and carryover sampling. Evaluation metrics include FE score, AUC, and GME, with statistical significance assessed using the Wilcoxon-signed rank test. Here are the results. NIE-based achieves the highest overall performance with an FE score of 0.76 and an AUC of 0.84. ARF with Edwin showed a slower start but gradually caught up, while deep neural network and boosting models underperformed in this dynamic non-stationary setting. To assess whether these performance differences were statistically significant, we conducted Wilcoxon-signed rank tests. The new hypothesis assumed that any observed performance advantage was due to random variation. A p-value below 0.05 would allow us to reject the rule and conclude that the model truly outperformed its competitors. The results confirm that NIE-based significantly outperformed LSTM with p-value equals to 1.8 times 10 to -3, with an effect size R equals to 0.79, where its performance was statistically indistinguishable from ARF, which p-value is about 1, suggesting that ARF eventually converged. The key takeaway is that models with rapid lightweight updating mechanism tend to outperform more complex static architectures when faced with shifting data distributions. Why does NIE-based perform so well? Sharp analysis shows that for classical financial ratio equity to debt liquidity, cash and debt account for approximately 30% of its prediction decisions. This variable consistently appear across different models, reinforce their credibility. This makes models' prediction intuitive and transparent for managers and regulators, improving trust and usability. 3 key insights emerge. First, adaptability is paramount. NIE-based maintained strong performance across multiple drift events. Second, ensemble models like ARF eventually close the gap through continual updates and diversity. Third, static deep network deteriorated over time, demonstrating that model complexity alone does not ensure robustness. Ultimately, adaptive and lightweight learning strategies outperform static architecture in non-stationary environments. In conclusion, we developed a real-time interpreter early warning framework for financial distress in Brazilian listed firm. NIE-based consistently led during early drifts with ARF coverage later with less at a 6% AUC difference. The system is both data efficient and deployable, offering practical value for financial monitoring in volatile markets. Our contribution are fourfold. This is the first large-scale comparison of 10 models across 4 learning paradigms on a real-world imbalance data stream from an emerging market. 2, we propose an end-to-end adaptive pipeline incorporating sliding window retraining, drift detection, and explainability. We provide empirical evidence that continuous learning simplicity can surpass complex model under drifts. And 4, the framework meets regulatory standard for interpretability, making it suitable for decision-making in real-world financial systems. In practice, this pipeline could support a quarterly dashboard for firms and regulators. For instance, firms with declining liquidity or raising debt could be flagged in red. Auditors receive clear ratio-based explanations, regulators obtain early signals, and investors gain time to react. This leads to proactive risk mitigation and more resilient financial systems. That's all for my presentation. Thanks for your listening and patience.